A book which I read recently, which I absolutely love, is The Bond King by Mary Childs. And the subtitle kind of summarises the book really succinctly. It's how one man made a market, built an empire, then lost it all. And it's the story about Bill Gross, who's this really colourful character who takes a very staid market, the bond market, and completely transforms it, and eventually builds the biggest fund manager in fixed income on the planet. And it's a really fascinating insight into all the kind of political intrigues behind the scenes and how one of these really big fund shops works and the culture within the actual fund manager, which I think is really fascinating. And also what you'll learn from the book is how bond funds are run and how you can make a lot of money with bond funds, which is perhaps quite surprising. So I was really lucky that my co-host from the podcast, Michael Pugh, was able to join me and ask questions of Mary Childs. And I think we got some really interesting insights. And Michael asks a cracking question at the end about film rights. Now, if you want to hear the whole interview, this is a really shortened version, then you can do that by listening to our podcast. And you can find that in all the normal places, Spotify or Apple Podcasts. So I hope you enjoy the book. I really recommend it. And here's our interview with Mary. Okay, well, thank you so much for joining us, Mary Childs, to talk about your book, The Bond King. And we both really enjoyed it. Me particularly, because my background is in fixed income. So, I'm a bit of a bond nerd. So for me, it was great.
Yeah, I don't know if you did any sort of market research for your book, but if you had, Ramin's face would have just come up as the market research.
It's so weird that did happen. Yeah, I did look into it, and it was just, I'm so glad to get to actually meet live now.
So let's just give your background. So you're co-host of the Planet Money podcast on NPR.
That's right.
And you're also a financial journalist. You've written for all the big financial news outlets. I think what we really would be interested in is how you got started on the story. What interested you in Bill Gross in particular and about Pimco?
Yeah. So the short, easy answer to that is it was just random luck. I had been covering bonds at Bloomberg for a number of years as a beat reporter, just, focus on the credit market. And the job to cover Pimco just became available. And I was like, that sounds cool. It's Pimco, BlackRock. It was a bunch of the big asset managers. And Mohammed Al-Arian had just left Pimco. So I was kind of like, bummer. I guess I missed the big story. But kind of more relevant to the conversation, perhaps, and less particular to me, is that I just think Pimco and Bill are so foundational to the bond market that it was just wild how little public awareness there was and public, I don't know, like information to even dig in. If you wanted to understand the bond market, understand Bill, understand Pimco, you had to read all of Felix Salmon's old blog posts and, study it was just pretty inaccessible in a way that I thought was unhelpful and silly. So I figured once all of the action started in 2014, the events that led to Bill's ouster from Pimco, I was like, this seems like a great story. This is a really fun, dramatic yarn, but it also communicates so much about the world and so much about this influential corner of the market.
So I love the tagline for the book, how one man made a market, built an empire and lost it all. It kind of sums up the journey, right? The arc of Bill Gross.
It's a bit of a spoiler, I've learned, yes.
But it's incredible how he transformed the market, wasn't it? Because you described the story about when he first started at what was essentially just a kind of a place in the sticks, stuck in Newport Beach, clipping coupons on bonds. That's how he kind of got started, right?
That's exactly right. And I think, you're right. California was not the place to be. The buy side was not the place to be. This was even pre-Liar's Poker. So this is kind of you wanted to be at a bank, being that kind of official person and managing relationships and making recommendations, and being on the buy side was kind of, ugh. So, and that was reflected in how much you got paid as well. It was a pretty enormous differential. So Bill was like, ugh, this is the best I can do. This is the job that I got. So here we are. And yeah,
we've all been there.
I know, right? It's I find this story very accessible. It's like, And so he's doing this job clipping coupons, and to some extent also being a credit analyst. He's helping make judgments as to what kind of companies his company should lend to. And this guy comes along and basically sells him on the idea of trading bonds, which was a radical concept at the time.
So instead of just having a huge swath of bonds and just having a bond ladder,
Exactly.
and as one matures, you buy another one. Instead of that, instead of just getting the income, you're actually saying, well, this bond is looking kind of attractive or cheap. So I think what I'm going to do is buy this one and then sell the one I've got.
Exactly.
And that increases your return. Is that right?
Well, if you do it well, yes, exactly. If you do it poorly, it can decrease. And Bill's suggestion is, I mean, this is radical. He's like, why don't we not do it that way? Why don't we remove that safety entirely and just mess around and see what happens?
And it was, by any measure, it was just spectacularly successful, wasn't it? Because
yes, quite.
I think he went from almost no money under management. What did he start with? Something like
$5 million. Yeah.
To managing the biggest bond fund on the planet.
Yeah. $293 billion in Pimco total return at its peak in just the mutual fund. So that's not even counting the separately managed accounts that kind of travel alongside. So yeah, it was absolutely enormous and wildly successful. And, I think he's arguably the most successful bond manager. So although I think, there are a couple, Jeffrey Gundlach would maybe take issue with that.
And when I read your chapter, I didn't realize it was that extreme.
Right?
In March 2011, he sold all of his treasuries, like all of them. It's like the deepest, most liquid market on the planet.
Right.
He's a conviction investor, Ramin.
But it's just astonishing that you could be that confident to go to zero for treasuries, and yet he did. And there was no pushback. Somehow, you'd have thought there's a risk committee that would say this is crazy.
A lot of people pointed to that lack of risk management, that, this is a guy who built a firm on saying like, oh, Kelly criterion, I learned in Vegas. And, we don't stray from like betting 2% at a time, and then all of a sudden it's 0% treasuries. Like, where are we on this?
But how did that affect his kind of standing at Pimco? Is that really the kind of point at which they questioned his leadership?
I think so. I mean, it was such a big, bold, spectacular call, and he got so much attention in the press for it that I do think it was like flag in the ground, like I mean it, full conviction, like you're saying. And within and without Pimco, I think it was really kind of, this guy had delivered such an above market performance for so long that this was shocking in every way. Like you're saying, it's risk management, it's deviating from all of those things that made the firm so great and delivered that performance. And I think that outside of Pimco, people were like, oh, that's weird. Like that's an odd, like people were kind of, whenever you see a big call from like a big fund manager, there's kind of like a little thrill. It's like, oh, like we're really in it now. Like this is going to be fun. And I think that's definitely the case. And then when it starts to turn, everyone was like, oh, I never really thought it through. Like what was going to happen? Like, I think everyone was like, Bill Gross can be wrong. Like, huh. And a lot of clients were like, all right, that wasn't cool, but like, I trust him. Like I've been with him for decades. Like this is fine. And, and there's a story from a fund manager, a former Pimco guy in the book where he's like, if anybody else had taken a swing like that, they would have blown up. You were only down, like you did okay. And Bill's like, I mean, kind of like, and both, that's fair. I do think that like this relative to the size of the conviction train, like he did great, but like, oh, so clients stuck with him for the most part. At Pimco, I think it was just like, that was weird and bad, but okay, like let's move on. And had the events of 2014 not started to percolate, I think that, things could have been fine. I think you could recover from that.
Was it a kind of overconfidence because they'd gone through the financial crisis in 2007 to 2009, better than anyone, right? Pimco. Yeah. And they called that right. And is it the case that once you've been through that, you see crises everywhere to profit from, even if they don't exist?
Yes, I think that's right. I mean, and you'll note that whenever like Michael Burry opens his mouth, we're all like, guy who called the crisis. Like definitely in the media, we feed that just a little bit. But I do think that's right. I think it was sort of like, you're this big, important guy and everybody's hanging on your every word. It's very easy to lose perspective.
And in terms of how he actually generated the returns when there was a good year, I was a little bit surprised by that as well. I mean, obviously, you've got things that you talk about in the book, like structural alpha, but then they were talking about things like a rule I'd never heard of, which is the 17A7. So I thought, I'd never heard of that before. So how does that work? I mean, do funds use that all the time? What is it? first of all?
So not all funds. This is one of those things where, I've done a deep dive on Pimco, and like to some extent that made it hard for me at first to figure out, like, is this normal? I'm like, oh, 17A7, everybody does that all the time. And then I mentioned it to like the head of some enormous fund management company, and he was like, we do not do that. And I was like, okay, sir, like, whoa, like it was like I had just said the most inappropriate. He was like, I need to have you arrested. Like, don't say that word in my house. And then like this other guy at like a very shady shop said the same thing. And I was like, is 17A7 bad? And like, you'll see that, the SEC was looking at it, and there were a lot of letters being like, please don't take it. We really like it. So there are other people that are willing to, Pimco is obviously among them, but there are other firms that are willing to put their names on it because it is useful. When you start a new fund, a lot of times, you'll kind of shuffle bonds from other funds just to fill up the new guy. And like, that's a 17A7 trade because, they're all, the basic thing is it's a 40 Act loophole. It's not really a loophole. It's just a regular, part of the rule. But you basically can trade within funds if they're under the same family. And so Pimco figured this out. And this is kind of, I put this in the category of like, if it's in the law, then you can do it and like have fun, like go for it. So I think, they were like, okay, it works this way, it works that way. And let's kind of use this as much as we can. And that can is a bit subjective, right? That's going to differ between people and between firms. So
I was a little bit shocked by the thing they did with odd lots as well with the ETF. Because what was really transparent was that there was something odd going on. So just to kind of set the scene, you've got the total return fund, which was massive, and essentially a kind of fixed income juggernaut. And then they come up with a new wrapper for it, an ETF wrapper. So it's a little bit cheaper, same idea, same stuff roughly, same strategy. So should be similar returns, right? But that wasn't quite the case, was it?
That's right. The ETF ended up trouncing the mutual fund product, and they're supposed to be the same product, the same strategy, the same stuff. But I guess in just a fit of enthusiasm, like wanting this new product to do so well, they just overshot and it did too good. Like it did far too well. And, journalists started noticing like, this is a bit odd. Why is the ETF diverging so substantially from the performance of the mutual fund it alleges to track? And, this kind of became evident. They had explanations for it. They were like, oh, something in the mortgage market is very good, and we did that. And you're like, oh, that's kind of inadequate. And it was because, these emails that came out when the SEC investigated, it turned out that they were, intentionally, I guess you could say, seeking out odd lots. So small, kind of off the run, little gnarly, misshapen pieces of, MBS that had been paid down or, had just been around for a long time and had kind of gotten, had lost their kind of beautiful round lotness or were, more work than maybe other people would view as necessary. And so they trade at a discount, but the pricing systems didn't account for that discount. So you take an odd lot, you slot it into the pricing mechanism that Pimco doesn't control. It's not their fault. And lo and behold, it's priced like a round lot. And I think, they were just exploiting this pricing mechanism. And I remember when this came out, because other mortgage traders were like, am I going to get in trouble? I didn't do that. Like, I don't mean for my odd lots to get priced at round. Like they just do that. And like, it speaks to intention, right? Like you have to, this is the chapter where there are some regrettable emails where it's like, find me odd lots by the end of the day. And, had they not had those emails, I bet the SEC would have had a harder time, but ascribing that intent, right? But it was a pretty successful strategy. The ETF did amazing, too amazing, and, has continued.
This whole story of Bill Gross and his kind of rise and half fall is ideally suited to a movie, right? Have you optioned the book rights yet?
I can't disclose, Hollywood confuses me, but people are interested. I can tell you that. And it's been fun.
Who do you want to play Bill Gross?
Oh man. So I started out with Steve Buscemi in mind. And then I got obsessed with Michael Shannon for a little while. And now I think Bill Nye.
Really? Okay.
Can you see it?
That would be good. I could see that.
Be the best. I mean, that one really, once that got in my head, I was like, oh man. And now I'm like, that's my favorite right now.
But he even looks like him, he's got the same build. Yeah, I can see that.
He's got the same build, and he's got that kind of like intensity that he can ramp up when he wants, and like the kind of like head shaking. I don't know. I feel like he could phone it in and crush it,
Anyway, Mary, that's been brilliant. Thank you so much for spending the
Thank
time
you.
with us.
This was
And
really fun. Y'all are a delight.
And I love the book. I just say, you're going to learn a lot about the bond market, a lot about the culture of how money's managed, which I think you don't normally see. You don't see how the sausages are made usually. So, I really recommend it. So thank you so much.
Thank you.
Me too. I mean, I actually listened to the audiobook where it was just great because you narrated it yourself, right? And just hearing you read out all those aggressive emails and quotes was making me laugh.
I tried to put my whole heart into it. I hope it came through. We've all gotten those emails, right? So yeah. Well, thank you. This was really fun, and I appreciate y'all having me on.
Yeah, thank you for your time.
Thank you.
Back at you.